2015.
Yeah, here we go. The euro stuff is interesting. Watching the euro fall after Mario Draghi's comments, it's not too. Everyone pretty much expects that the ECB is going to do something new, some sort of sovereign QE. I think one of the big questions is going to be like, will it do anything? I mean, I think no one really has any idea.
Well, everyone thought they were going to do something this past year, right?
They're going to do something. They're going to expand the balance sheet, but will there be any effect? Bond yields are already incredibly low in the Eurozone, and the Eurozone is broken and has problems in distinct ways, and it's not clear that the ECB really has the tools at its disposal to solve the problem. So yeah, they're clearly going to try more. Draghi is going to purchase more assets, but I think one of the big questions in 2015 will it have any effect whatsoever?
Right, is it going to solve any of the economic problems? But it may, as we saw with quantitative here, with the Fed, at least it may juice up asset prices, right?
Yeah, I mean, it may, although, asset prices in much of the Eurozone actually haven't been that bad, despite the bad economy. Maybe there's some hope that the weakened euro will help exports, but I think the expectation is that will only move the needle so much. Really what you want to see is accelerating bank lending and credit begin to flow. And it just seems like there's so many structural issues that remain in the Eurozone that...
Right, that we're not seeing any of that.
Right.
Okay, but here in the U.S., though, look, strategists last year were saying, I remember, don't expect that many gains. We might see single-digit gains for 2014. And here we were up 11%. Say for December, we would have probably been up even more in the S&P. So what about this year? What are strategists saying for 2015?
It's funny. There's basically no bears at all. Nobody predicts the market's going to decline. So, most people are expecting further gains. The other interesting thing is, the real surprise of 2014, yes, the stock market exceeded optimistic expectations, but the real shocker was how good bonds did. The huge bond rally, almost no one going into 2014 guessed huge stock rally and huge bond rally. And, I think once again, the predictions for 2015 are stock rally, but bonds are expected to fall again.
To crash,
so the same,
essentially, right?
Which is the same prediction that bond strategists have been making for years. Nobody is predicting a big stock rally and a huge bond rally again, but who knows?
But who knows, right? And surprisingly, that big bond rally didn't really help PIMCO at all. It helped them just a little bit, but they still weren't able to outpace their peers. So I guess the question for everybody is, will the Fed really raise interest rates this year?
The thing is, they might, and it still might not help the long end of the curve at all. You still might not have, bonds could still rally. Look at 2014. 2014 was a year in which the market sort of brought forward its expectation of when the first rate hike would be. Clearly, the economy accelerated in 2014, and yet still, there was no sell-off in bonds. So maybe the Fed will raise rates sometime late in 2015, and it might,
and that's no guarantee
that the 10-year is going to sell off.